Hello friends, before I begin this video, may I request a few seconds of your time? No, it's not what you think it is, but it's as important. You see, those of you who've been connected with me for long enough have given me a lot of love and affection and have appreciated my work on television interviews, print and electronic media articles, etc. And you know me as a pure prop trader, which I have been doing since 1986. So you see, we focus on doing things, which is why we have zero idea about digital marketing, about advertising, or how to reach our work across to a bigger segment of the audience. But we want to keep our work free. And just because it's free, it doesn't mean it should not reach out to a whole lot of people. Can we depend on you to give us the word of mouth and other push like sharing our work with your social media platforms, with your social media groups, etc., so that we can reach out to a wider audience and spread the virtue of knowledge? If you can do that, it would be absolutely great for us. Now, let's dive right into the video. You see, last week we discussed how the naked short sale ban by SEBI was unlikely to make much of a change to sentiments, and I discussed why. The hyperlink to last week's video is in the description below this video and in the pinned comment below. So let's not go there. But the first two trading sessions of the week saw the markets go down and then a later recovery occurred. So, short sale ban apart, the Nifty at least climbed a wall of worry and hit a new all-time high. The Bank Nifty, on the other hand, lagged and relatively underperformed the Nifty 50. Will this performance, where the Nifty is headed to all-time highs and make newer highs, continue this week? Now, that is what I want to discuss with you in this video itself. Let's dive right in. Coming up on your screen is the weekly market roundup window, which tells you that it was the Nifty 50 which logged gains, whereas the Bank Nifty actually lost in terms of week-on-week basis. The US dollar index, the Dixie, was almost unchanged, and the USD INR, which is the United States dollar versus the Indian rupee, actually fell, which means the rupee strengthened. Now, an unchanged dollar saw gold decline marginally, but silver logged mild gains. Natural gas flared up because of weather-related reasons. I have told you many times in my past videos that winter is a peak demand period for natural gas for heating purposes, whereas crude oil fell almost 1.5%. I have been updating my free Telegram channel with my thoughts on natural gas and crude oil. Do connect with me on our free channel and make use of what I share. As a matter of fact, on 10th of December, I said Vladimir Putin, the president of Russia, will play Santa Claus and gift you some good trades for New Year's and in Christmas till his elections on 17th of March 2024. And there you have, oil and gas have started perking up. The Indian 10-year benchmark bond yield fell 6 basis points, which means bond prices rose. And that was one reason why the Bank Nifty cushioned its declines. The NSE market cap gained 1.04% and MWPL went up routinely post-expiry. The US indices rallied, and the more prominent rally was seen in the Nasdaq index, which is the tech-heavy index, and it had a salutary effect on our technology stocks as well. If you remember, my Livemint column last week was titled Watch Technology Stocks, because they have a significant weightage of over 13% and influence the Nifty with their own direction. Friends, the weekly market outlook done. I now come to our in-house indicators. I start with the MWPL, or market wide position limits. Now, what you are seeing on the weekly chart of 20 weeks is that the MWPL has closed at 39.63, which is very simply the highest it has ever been in the last 20 weeks, and that too spread over 5 different expiries of the futures and options derivative series. There's a very good chance before expiry is seen in January, we could cross the round number of 40%. That would tell you that commitment of buy and hold traders is significant here. So risk appetite was not really too much of a problem. Now let's go to the index and stock futures turnover, which is a sum total of 3 concurrent series. So it's January, February, and March. What you are seeing is for a second consecutive week, the turnover in individual stock futures fell, whereas the index futures turnover rose a little bit. So MWPL indicates buy and hold traders' risk appetite, and the turnover indicates the intraday traders' risk appetite. Intraday traders seem to be a little shaky. I don't blame them. This is an all-time high, and retail guys are supposed to be nervous. Now let's go to the advanced decline ratio. This is an average of all 5 trading sessions of the week. And what you are seeing is that the advanced decline ratio fell from 1.38 to 1.12. That means for every 100 losing stocks, there were 112 gaining stocks. Now this ratio falling tells you that the average retail trader showed lower buying conviction at higher levels. But as long as this ratio remains above 1.0, bulls still have a fair chance of pushing markets higher. Now friends, I come to the basis. Now basis is nothing but the premium or discount prevalent in futures as compared to spot. I told you a fortnight ago that these lofty levels of the basis, which were at a period high in this 20-week chart, could not sustain. And there you have it. The basis has come down very sharply in the last fortnight. And what you are seeing is the Nifty and the Bank Nifty lose almost 50% of their peak basis reached a fortnight ago. Now, as long as the basis is above 0, which means futures are trading at a premium to spot, the bulls still have a chance. I would be worried only if the basis turned negative or inwards. That means the futures start trading at a discount to cash. But that's not happening. So far, so good. Now, friends, I come to our in-house exclusive indicator, the impetus, which you've been trusting for more than 3 years. What you are seeing is that the Bank Nifty fell marginally, but the impetus was more or less unchanged. The Nifty recorded gains, but the impetus was lower. So there wasn't much force or momentum in bullishness in the Nifty 50. Let's not forget, the buy and hold traders are bullish, but the intraday traders seem to be cautious. Obviously, the momentum or the impetus is not all that great. Now, this is something that we need to watch extremely carefully, and this is something that I update on my social media accounts, especially on our free Telegram channel, which is one-stop shop for all our research and output across all our other social media accounts. This is the one place where I post most amount of our work. Do connect with me there. The contact coordinates come at the fag end of this video. Now, friends, I come to the LWTD, the lift, weight, thrust, drag indicator, which is again our exclusive in-house indicator. You won't find anywhere on the internet. What you are seeing is a sharp decline in the LWTD. It has fallen from 0.02 in the prior week to minus 0.38 in the week gone by. That tells you that fresh buying support on declines may be a little milder, but short covering might just cushion the declines. That's not really what I would have wanted. Frankly, a sustainable rally would have come if the Nifty and the LWTD were rising together. That would have been an ideal, strong bull market. But let's not forget, the Bank Nifty is weak and the Nifty is strong. I've often written in my Livemint column that these two indices are like the bicycle tires. One is flat and the other seems to be inflated. And one is going forward, the other is going backwards. You can't have a rider not fall off a bicycle when two wheels are going in opposite directions. So there's a little bit of a dichotomy here, and LWTD again is something I update on a day-to-day basis on our social media accounts. Do connect with me there. Friends, our in-house indicators done. I now come to the bond market signals. Remember, I've been at the forefront of advocating watching the bond market before the equity market, because this is the market that funds and fuels the other asset class prices. Now, the Indian 10-year benchmark bond yield, as you can see on your screen, has fallen by 5 basis points, I beg your pardon, and it's trading below its month-long moving average. What it tells you is that bond prices are inching higher because the markets are slowly but surely of the opinion that sooner or later interest rates might basically come down because of electoral reasons. Do remember, 5 dozen countries have elections in 2024. Taiwan is already leading the way. We have India, we have USA, and a whole lot of other countries which are going to polls. And in an election year, interest rates have a good chance of coming down, which is why our gilt fund portfolio is doing even better. As you can see on the screen, what you are seeing is a minimum of 0.59% going all the way up to 0.75% gain since 14th of December when I first recommended these 4 gilt funds. Good times still ahead. Remember, this is only the first tranche. I still have some more strategies in the debt market for fixed income traders who want absolute 100% sovereign guarantee from the central government of India. So we've started gilt funds after laddering Indian 10-year benchmark bond yields for over 2 years now. Friends, the bond market's done. I now come to the Bank Nifty, which fell and led the way down. Now, what you can see on the daily chart on your screen is a 0.93% decline, and the Bank Nifty rose on 3 out of 5 trading sessions. The price has tested the month-long moving average and bounced higher from there, but the average unfortunately appears to be flatlining or going sideways or flat. Therefore, compared to the Nifty 50, whose chart we will see in the future slides, the Bank Nifty appears to be relatively weaker. The fall on the first 2 days of the week was more pronounced as compared to the rise on the last 3 trading sessions of the week. So the index has notched net week-on-week losses. Coming to the weekly chart on your screen, what we are seeing is a bearish hammer, which is seen on your weekly chart. And the prior week was a long leg doji or a juji formation, which is a sign of indecision. Now, I told you that after indecision, we need to watch what happens in the following week. In the following week, that is last week, what we have seen is a hammer, which is a sign of nervousness. Although the bulls have managed to pull the prices higher towards the upper end of the weekly range by closing time, there is definitely, relatively compared to the Nifty 50, some weakness here. Now, I had told you about the throw under and throw over formation that we've seen on the Bank Nifty. We've seen a throw under appear in the month of October, followed by a throw over in December. And the throw over has had its impact on the price. The price is wobbling around its highs at approximately 48,500 odd levels. We need to cross this threshold if the bulls are clearly to be in the driver's seat. The 46,370 is a near-term support to watch out for. I've marked it with a horizontal trend line, and we need to basically want the price to continue to stay above its 25-week exponential moving average, which is a 6-month-long holding on cost of an average bull. So the medium-term outlook remains positive for now. Friends, in the week before last, This index was at number 6 of the most volatile counters list based on statistical beta that we maintain in-house. It fell by one notch to number 7. It is also because volatility on individual stocks rose faster than the Bank Nifty. Last week, I advocated an estimated range between 49,350 on the upside and 47,000 on the downside, which held perfectly well. Do note, last week's low in the Nifty, Bank Nifty spot was 47,010 points, which is just 10 points above our crucial support at 47,000. This is thanks to our statistical trading model, the IBEX. The coming week, I estimate a range between 48,875 on the upside and 46,550 on the downside. Friends, do continue to watch the daily, weekly, and monthly pivot levels that I keep putting up on our free Telegram channel, and that's the only place where you'll find these pivots for intraday, for swing and buy and hold traders across the indices and commodities. Friends, the Bank Nifty done. I now come to the Nifty 50, which basically outperformed the Bank Nifty by rising 0.85%, and it rallied on 4 out of 5 trading sessions, as you can see on the daily chart on your screen. The Nifty has basically gone to the all-time high and is poised to test the 22,200 levels, which I have been advocating since a fortnight as a critical Fibonacci target area, which it could, provided the 21,450 level holds, and 21,450 indeed held very well. Now let's take the weekly chart on our screen. What you are seeing is that the Nifty has made a bullish hammer after a long leg doji or a juji formation in the prior week. The hammer itself is a sign of slight caution. I would have wanted an outright bullish bodied candle, but a hammer it is. And note how the week's low is 21,449. And I have been telling you that the Fibonacci level of 21,450 is the absolute support to watch out for. We missed it by 1 point. Now the price is above its 25-week exponential moving average, which is a 6-month long holding on cost of a average bull. So the medium-term outlook is also positive. The Nifty seems to be relatively stronger than the Bank Nifty. In the week before last, this index was number 11 on the most volatile counters list based on the statistical beta ranking we maintain in-house. It fell 6 notches to number 17. And volatility actually fell, which is good. Last week, I advocated an estimated range between 22,150 on the upside and 21,250 on the downside. In the coming week, I estimate a range between 22,325 on the upside and 21,450 on the downside. Friends, please do watch our daily, weekly, and monthly pivot levels on the indices as well as commodities to help you trade futures, options, intraday, swing, and buy and hold trades. Friends, I now come to the last bit of statistical analysis wherein I gauge the risk appetite of a retail trader based on the turnover contribution of the 4 segments in the F&O space. Coming up on your screen is the weekly chart of the 4 segments in the derivative space, and what you are seeing is the index futures saw unchanged turnover contribution, which is shown as blue line, almost unchanged, 1 basis point down, that is. Stock futures turnover surrendered 4 basis points in turnover contribution. It is shown as a red line. Now, futures turnover falling is not exactly good news because the futures are higher risk instruments. They require higher amount of capital and they are more volatile. So mark-to-market margins, etc. are in the picture. The fact that futures turnover was lower would mean that traders were playing safe. Now, index options, which are the safest, relatively speaking, of course, instrument to trade, saw 5 basis point decline in turnover contribution. It is a green line. whereas stock options saw 9 basis point increase in turnover, which is indicated as a purple line. So risk appetite seemed to be mildly higher in the option space, but futures was frankly wanting. So I want this contribution to be significantly higher in the week ahead. Friends, I would now come to my own trading strategy for the week ahead, which is what I have been sharing with you since the last couple of quarters. And last week, I advocated watching the technology space in my Livemint column. And here you have a 13.62% weightage of the technology space in the Nifty 50 that swung the Nifty higher, which is why Nifty gained, but the Bank Nifty fell. Now, the strength in the Nasdaq also played out very well, and it helped the CNX IT gain 4.79% last week. Now, this level, CNX IT level, is the highest we have seen after the week ended 4th of April 2022. A breakout above that level may see technology stocks go up higher, basically also due to some amount of short covering. But volatility will be frankly quite high, much more higher than an average retail guy can handle. PSU stocks have been our go-to segment where high volatile trading opportunities is concerned. So I would continue to seek trading opportunities based on our pivot levels and continue to play PSBs or public sector banks as well. I advocated some weakness in base metal prices on commodity markets, and sure enough, you saw aluminum, copper, and other base metals fall last week. Now, that may lead to metal companies' stock prices consolidating in the week ahead. I will continue to seek theta decay opportunities in the non-linear derivative segment in oil and gas, which is deeply out of money call option writing, provided my delta and absolute yield return on capital criteria are met. I had advocated on my free Telegram channel on 10th of December that oil and gas will rise till March probably due to the Russian elections, and Putin will basically play Santa Claus to bulls. Now that's coming about, and fairly reliably at that. Now, barring the echo chambers who are going to be screaming about a bull market or maybe even a super cycle, I'm frankly not betting on a bull market in oil and gas. This is more, in my humble opinion, of course, more of a temporary blip than a bankable up move. So I will continue to seek theta decay opportunities in non-linear segment. Provided the price rises very sharply, I might even go into linear return strategies on a strategic trades in the futures segment, but at significantly higher levels, of course. Bullion remains a buy on dips, as I have been advocating, and the expected rate cuts due to the election in almost 60 countries this year. Bullion is still leading the pack as far as buying the dips is concerned. Now, this is a sentimental market, and sentiments at this point in time seem to be indicating another upthrust if at all prices decline. Friends, before I say goodbye in this video, a reminder to subscribe to our YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put about here. In the comment segment, I'm always eager to welcome your inputs about how my work is helping you to earn better profits and what more I can do to help you even better. Hey, a reminder, please help me to reach out to a wider audience by sharing my work with your social media friends and contacts, social media groups, etc. I thank you for your patience in being with me in this video till we meet again in my next video. This is Vijay Bhambwani signing off for now. I wish you have a very, very profitable week ahead. Take care. Bye-bye.